Alright, friends, welcome back. This is Module 1, the Architecture of Control, and Lesson 1, the Origin of Modern Money. So we will start the market intelligence section and program by understanding the core ideas and principles how money as a thing actually evolved over time. And of course, this is DeFi House, and we will cover everything from a bit of a different side, deeper side, rather than textbook university based information about finances. So if you look at today's financial markets, everything, including stocks, bonds, crypto, real estate, everything floats on one invisible ocean, which is credit. To understand markets, you must understand how a credit system itself became the actual money. So, step 1, from gold to paper. So for most of the recorded history, which is fake anyway, but based on what we know, so to speak, money meant a thing, a metal with scarcity, which was either gold or silver. Different metals were also included as well, but to keep things short and simple, gold and silver as the main metals. So governments minted coins, but the value came from the metal itself, right? So in the 17th century, this began to shift. Merchants didn't want to carry gold on ships, so they stored it with goldsmiths who issued a paper receipts. So those receipts started circulating because everyone trusted the goldsmith to redeem them, right? So that was the birth of representative money, paper backed by metal, right? So instead of carrying heavy metal coins and multiple coins in one place, what basically happened, people stored the coins with the goldsmith, and the goldsmith issued a proof and a receipt, so to speak, that yes, this guy is holding this amount of gold, actual physical gold, with me, right? So this acted as a proof, because then someone else with that paper, the proof of assets, the proof of receipt, so to speak, can then go to the goldsmith and get the actual coins. So by the early 20th century, nearly every major currency was linked to gold. Then came 1914. To finance World War I, nations printed more claims on gold than they had gold itself. So this is where the whole thing began to sink, so to speak. So convertibility was quietly suspended. The link between promises and metal broke for the first time on a global scale. And everything began the moment World War I basically was ignited, so to speak, from a very high level, simple stuff. Then step 2, 1944 reset, the Bretton Woods. So after World War II, 44 countries met in Bretton Woods, New Hampshire. They agreed that the US dollar would be the anchor currency, convertible into gold at $35 per ounce, and all other currencies would peg to the dollar. For a while it worked. The US held most of the world's gold, and global trade expanded. By the 1960s, the US was running deficits to fund the Vietnam War and domestic programs. Foreign central banks, especially France, started asking for gold instead of dollars. In 1971, the biggest event happened. President Nixon suspended the gold convertibility. That decision, known as the Nixon shock, ended Bretton Woods and created the system we live in today. Money, which is fiat money, so to speak, a currency backed by nothing except government decree and collective belief. So if you look at it from the more magical perspective, spiritual side, money is basically a spell. And as long as the majority of the collective consciousness believes in it, that this paper holds value, the spell is working, right? But if you really think about it, this is nothing than a promise of nothing, that you trust certain organizations, governments, that yes, everything will be okay. And this is why on money, on a dollar, on a $1 bill, it says in God we trust, right? Because the system basically runs on thin air. So step 3, money becomes credit. So here is the part that the textbooks simplify. Okay, when gold backing disappeared, the world didn't just switch to printed paper, it switched to a credit creation by the banks. So under fractional reserve banking, which is the core element within all of this mess, so to speak, commercial banks don't lend deposits, they create new money when they issue a loan. And this is happening ever since, still today. So when you go and get a mortgage to buy a house, they issue fake money, new money into the system, so to speak, and give you that money, and then you have to work hard to repay all of that money, plus interest. Okay, so example, you deposit 1,000 euros into the bank. The bank keeps only a small reserve based on the law. It's usually 10%, which would be 100 euros in this case, and lends the rest of the 900 to someone else. So that 900 is now new money in circulation, while your 1,000 euros still shows in your account. So you see what the 1k, but actually only 100 euros is stored as a fractional reserve, so to speak. Okay, so the system's total money supply just became 1,900, right? So multiply that across all the banks, and the majority of money in modern economies exists only as a bank credit. So central banks provide the base, the reserves, but private banks multiply it using this law based on the fractional reserve banking. Okay, so debt as an expanding system. This is what you have to understand, because every single dollar and euro or other currencies is basically created as a debt. So the system must expand to survive. If all loans were repaid simultaneously, almost all the money would vanish, leaving only physical cash, which is roughly 3 to 5% of the total money supply. So that's why the governments and central banks constantly manage the interest rates and liquidity injections to keep the credit expanding enough to service the old debts. So as long as the debt is expanding, the markets is going to go up and the system still functions. And when expansion stalls, like in 2008, the system seizes up. So the Federal Reserve steps in with the tool called the quantitative easing, buying bonds with newly created reserves to push liquidity back into the system. So once again, if you really think about it from the high level perspective, this is all massive flywheel of nonsense. Yes, it sounds fancy. Yes, it has all of the financial and technological explanations, but at the core, there is nothing more than just a massive scam. So, inflation as a policy and not as an accident, okay? They need inflation. They cannot basically zero it, right? Because once you understand that debt is money, inflation stops being a mystery. A mild, steady inflation erodes debt in real terms and keeps borrowing attractive. Okay, so if a government borrows, let's say $1 trillion, and inflation runs at 2% per year, the real burden shrinks over time while the nominal GDP always grows. So that's why most central banks target inflation instead of zeroing it. Yeah, and 2% is usually the standard. Yeah, they aim at 2% inflation because deflation makes the debt heavier, while inflation, in a small and controlled manner, makes it manageable. Okay, so the best example is, of course, what happened in 2008. So in 2008, mortgage defaults revealed that a vast amount of safe, so to speak, debt was actually worthless. So the credit creation halted and money supply contracted. The Fed responded by expanding its balance sheets from under 1 trillion to over 4 trillion in just a few years. Those dollars went into the banking system, lifting asset prices, but not the wages. So the result was that the stock market recovered, the rich who owned assets gained, and wealth inequality widened. So that's the structural side effect of the credit-based money. Liquidity flows to balance sheets, not paychecks. That's the core element to understand. Central banks injecting the money into the system, they inject it into the markets and not into the day-to-day living people pockets, so to speak. So the hidden truth that universities and basic financial knowledge skip. So universities, when you study finance, and I did, and I had to quit after year one because it's actually a funny story. I was sitting in a hall, and the lecturer started to speak about financial markets, and at that time, I was actually on my laptop taking notes plus looking at the charts because I was doing my full-time trading as a job, so to speak. And what happened, she said, there is such a thing called investments into the financial markets, like stocks, but it's not recommended to anyone and it's very risky. When she said these few words, I understood that I have nothing to learn here in this university, so to speak, because finances in university was based on working and filling Excel sheets for the companies rather than learning how to invest the money. So I quit. Anyways, they often teach that central banks control the money supply, so to speak, right? This is the general narrative that central banks' main goal is to control the money supply. In reality, they control the price of the money, the interest rates, and supply reserves to a network of a few private banks that actually create most of the money. So the state doesn't print first and lend later. The banking system lends first, then central banks provide liquidity afterward to maintain stability. So the bottom-up money creation is why the credit booms precede recessions and why tightening cycles, like what happened on 2022-2023, hit markets so violently, because the oxygen of liquidity is being withdrawn. And now we have the crypto, now we have alternative markets, so to speak, that are actually deflationary as at the core. Even though this is not what they want, this is what they need, because the system cannot run forever. So there needs to be some sort of change. And even though this section and the whole module is not about that, I will not cover it, but it's a pretty clear what's going to happen in the upcoming few years based on the financial shift and reset, where the certain metals will be backed by the certain digital assets, and essentially as its core forming a new system with on-demand liquidity. So to sum it all up and close the first introductory lesson, the origin of modern money is actually the origin of the modern control. Once currency lost its physical anchor, it became a claim on future labor and productivity managed through the credit, interest rates, and policy. Okay? So, by understanding this, you gain clarity. Every market you will ever study, from bonds to Bitcoin, ultimately dances to the rhythm of this invisible credit engine. And even if you think that Bitcoin is different, so to speak, yes, it is, but traditional finance always has a way to kind of wrap itself around whatever market you give them, and through the ETFs, through different options, etc., based on traditional financial tools and markets, they can still manipulate the Bitcoin as well. And in theory, they can sell, so to speak, more BTC than there is in existence. This, of course, would create a problem, but at the core of a principle, it is possible. So this is a very simple, high-level lesson just to give you a very brief, without going too much into detail, of the origin of modern money, which is actually the modern control, right? And what's going to happen in the next few years is it's totally different, but to understand the core elements that we are about to cover moving forward, you have to understand the very simple, high-level, beginners-friendly, so to speak, information, how the whole thing is actually being evolved into money. So just to summarize it all once again, understand one very simple thing, that the currencies we have right now, the fiat money, is a claim on future labor and productivity managed through the credit, interest rates, and policies, the monetary policies. That's it. And yes, crypto is different, but traditional finance can still manage and manipulate that for their own benefits, so to speak. So that's it for this lesson. It's a very simple one, a high-level one, but we will go way deeper into all of these elements and aspects, so you have a very high market intelligence level moving forward after finishing all of these sections. Okay, so thank you, and I will see you on the next one.